All right, morning all. Good to see you guys again. Right, so welcome back to Morning Kappa. Right, so looking at the S&P 500, well, it fell on Monday, dragged down by a broad sell-off in the superstar AI as well as the tech stocks, led by the Nvidia. Right, as investors lock in profit amid growing fears of uh, uh, valuation bubble, as what the market are saying right now. So sentiment was also pressured by the caution ahead of Nvidia's high stake earning report on I think today, and uncertainty over the Fed December rate cut as inflation remains stubbornly high. So the market is now in a wait and see approach, right? For the first backlog US economic data to be released post shutdown. Right. So looking at our US trading stocks that we have published yesterday, we got FedEx Corporation. Right. So the stock has breakout above the $260 level. We can now expect the level to the stock to travel towards the $280 level on a strong momentum, followed by the next resistance at $300 level. So now if they counter to reverse, do watch out at $245 level for the immediate support, as it could indicate initial trend of reversal signal. Also next we have Valero Energy, VLO, right? So look at the chart right now. The counter is on its higher high market structure, comfortably sitting above the moving average, eyeing to reach the higher towards the $190 level. So if the stock climb up higher, we could see that it might travel towards the $200 level, rise 200 resistance level, right? So now if the stock slides lower below the 170, this might signals a shift to a bearish structure, right? So I think looking at the China A50 index futures and also the Hang Seng Index futures, well, it fell on yesterday as a new diplomatic spat between China and Japan over Taiwan scared investors and triggered the I would say risk of sentiment, right? So this geopolitical tension give investors a reason to secure profit first from the market strong rally. So I think a move that was also supported by existing global fear of the tech bubble as well. So the sell-off was rather broad, right? With the Hang Seng tech index was also falling, right? As the market pulled back on concern about valuation. So as you can see here, both index, China A50 futures as well as the Hang Seng index took a breather to push down lower, reflecting the concern. I mean, on the concern situation, right? Yeah, so on the WTI, crude oil fell on Monday session as the immediate supply fears gone as Russia's port resumed its operation after being shut down for 2 days by the drone strike, right? So I think the market gave back all of the Friday's risk premium as the resumption of the Russia export. Put the focus back on the dominant. Bearish narrative of the global supply issue, right? Also, some major banks are also forecasting a large market surplus and also lower prices coming into towards the end of the 2025, coming into 2026, right? Right. So coming back to our local market, Malaysia market, Looking at the FKLI, well, it closed slightly lower yesterday, resuming its consolidation as the broader market was, I would say, negative, reflecting a cautious uh, uh, holding pattern as investors await for the delayed US data. Right. Okay, so the index was prop up by selective buying in financials. If you can see here, like CIMB, and some consumer staples like FNN, Nestle, in which is still growing very strongly, right? In terms of weekly performance, right? So gains, I think, were kept by hawkish command by the US Fed and taking uh, uh, profit taking in tech and also plantation sector as the market lack of strong domestic catalyst. So I think earnings season would like to give, I mean, would likely giving some volatility to the market going forward, right? And also now if you look here, looking at the small cap index, LCI, which is the big cap charts, index charts, right? I would say the market now is looking at more of the big caps rather than the small cap, shifting the smart money in, right? So if you see here, um, uh, that I label, the one that I label here, I think market are pretty much stable at this juncture for the big caps. As sentiment is pretty much positive to look at the blue chips, right? For the small cap, I think technically this is the level where we are expecting the consolidation to be the deepest, right? So let's see if we end. I mean, we end 2025. I mean, towards the end of 2025, will there be any rebound higher for the small cap index? I mean, neutral to positive view of the overall market right now. Right. So also, if you see here, construction rebounded steadily yesterday, at least over 1%, as compared to others. Right. So hence, I think uh, we still can take a look at Gamuda as we have shared recently, and also we published recently. Right. So our first resistance, which is at 5.35 ringgit, followed by the second resistance at 5.50 ringgit, still remains intact. And now, I mean, now that the price has crossed higher above this 21-day average line, it should propel higher towards the first resistance with higher volume in coming session. So also. I mean, the stock also supported by the bullish signal in the MACD and also the RSI, right? Also, if I can bring your attention here, the newly listed company Cheating is also, I mean, now forming a positive market structure or formation, right? Now we are looking at 87.5 threshold. So if the price break above this level, we might see that the stock to travel higher to the 94 cent level, already on the positive sentiment of the construction sector. Right, so this is our watch list for today. And in terms of our Malaysia trading stocks, so we have Sunway Construction Group today. So the stock is now, I mean, has breakout above the 5.80 level on a strong volume. With that, we expect the momentum to remain bullish and so able to climb further to test the next resistance at 6.10 ringgit, followed by 6.40 level. So if the stock to clear below this 5.50 support, this could shift to a bearish structure. Also, next we have Padini. Padini Holdings, right? So the stock is experiencing a pending breakout at the 1.90 level. So if the stock to remain bullish in coming session, you expect the price to at least reach the 2 ringgit with a high volume followed by the second resistance at 2.10 level. So keep an eye at 1.80 level for any attempt of reversal. And lastly, for the FCPO, well, the price edged higher yesterday. I think this external lift was heavily capped by new bearish export data, uh, with I think with cargo surveyors showing that Malaysia palm oil shipment for the first half, for the first half have dropped from last month, right? So I think demand was really volatile right now. However, we still have a negative bias for FCPO, aiming for the immediate support at 40-50 level. Right. So we'll stop here and pass the floor to Nabil. Happy trading, everyone. Thanks.
Yep. Thanks very much, Aiman. Hi everyone, morning. Thanks for joining us this morning. So I'm here to report Public Bank's third quarter or 9 months 2025 results. Pleased to say that Public Bank's 3Q results were in line. The 3Q profit stood at 1.84 billion ringgit, which is down 4% year on year, but interestingly up 5% Q on Q. This brought the 9-month total sum to about 5.35 billion ringgit, i.e. flat year on year, and forms about 74% of our consensus full year forecasts. On a cumulative basis, i.e. a 9-month basis, income growth was mainly non-interest income driven, with that particular line item being up 18% year on year on stronger net investments and insurance gains. Meanwhile, net interest income was a bit more modest at plus 3% year on year, largely due to a 5 bips year on year net interest margin compression or NIM compression. For the 9 months, ROE stood at 12.6%, which was below the initial guidance of about 13%. But during the results briefing, this was then tweaked down to 12.5% to 13.0%, i.e. a downgrade. So as mentioned just now, the Q on Q trend was quite interesting. Net profit was up 5% Q on Q despite the OPR cut. But as expected, the OPR cut saw the net interest margin or the NIM drop by 8 basis points Q on Q to 2.10%. But this was mitigated by decent loans growth on top of very strong non-interest income from both the fee and also the non-fee income segments. But I think on NIM, management doesn't think this has bottomed out just yet, as the impact from the seasonal year-end competition for deposits hasn't yet been factored into the numbers. But with that said, management did keep its guidance for mid to high single-digit compression year on year for FY25. And I think just for comparison, the 9-month 25 NIM was down 5 basis points from the 2024 average. I think further out, continued competition on both loan yields and deposit costs are likely to weigh on medium-term NIM. But there are some mitigating factors. Number one, management is working on optimizing its asset mix by refocusing growth away from mortgages where the pricing pressure is a bit more stiff, and refocusing that towards the more profitable SME segment. And number two, management is stepping up initiatives to improve the cross-sell between lending and non-interest income products. Aside from NIM and ROE, all the other guidance items were maintained, i.e. loans growth of 5 to 6%, single-digit credit costs, and a 60% dividend payout ratio. So the latter implies a stronger dividend payout on the second half earnings. And perhaps lastly, some updates on the stake sell down. Management shared that there will be some more developments next year, during which the estate will likely look to dispose of its first major tranche. So post 3Q results, we had tweaked FY25 earnings down by about 2%, mostly on the income line items. For FY26 and 27, this was tweaked by 1% down each. Our target price is kept, however, at 5 ringgit. And despite the downgrade in the ROE guidance, we think this has been more or less anticipated by the market. And also, this does not change our thesis for the stock, i.e. we expect stronger capital return potential from Public Bank in 2026 onwards. So we maintain our buy call with a target price of 5 ringgit, which at yesterday's price implies 16% upside. So yeah, that's all from me. Thanks very much. I'll pass on the floor to the next speaker. Thanks.
Yeah, thanks, Nabil. Morning, everyone. Let me continue with a results note on 99 Speed Mart. This is their 9-month. We consider the results as within expectation. 9-month core net profit came in at 457 million. This is up 18% year on year at 72% of our forecast and 75% of the consensus. If we look at the results, our 9-month sales was up 13% to 8.4 billion. This is primarily supported by new store expansion. During a period, they have added 269 new stores, or 10% year on year, to bring the total count to 2,966 outlets at the end of third quarter. And same-store sales growth was encouragingly strong at 6.5%. This is, I think, underpinned by, firstly, higher minimum wage, which has increased the disposable income and spending power of the consumers. Secondly, the SARA program, which has helped quite a bit in third quarter. And in third quarter itself, they have also extended their operating hours by 1 hour. And so they open their stores at 9 a.m. instead of 10 a.m. starting July. So strong top-line growth together with a healthy gross margin expansion have more than offset the higher OPEX stemming from minimum wage hike. As a result, we saw 18% core net profit growth to 457 million. On a Q-on-Q basis, third quarter revenue saw a 12% jump to surpass the 3 billion mark for the first time. This is mainly due to the longer operating hours and the increasing SARA program contribution. If you can remember, there was a one-off SARA credit for every Malaysian citizen that we can redeem starting September. So that has provided a sales uplift to 99 Speed Mart in the third quarter. But of course, that comes at the expense of lower gross margin, as SARA purchases are mainly on lower margin necessity product and subsidized products. And the longer operating hours has also led to higher OPEX. So we saw a net margin compression by 0.4 percentage point, and more modest or the relatively modest Q-on-Q net profit growth of 5% as compared to the 12% jump in revenue. Dividend of 4.5 cents was declared for the 9-month period. This represents a payout ratio of 99 Speed Mart, considering activated for SARA, and is targeting to add more China expansion, which you can read from our report, 3.56 ringgit, which implies 41 times forward SARA program. Outlet expansion will continue to support growth. They have just opened their first outlet in Kelantan, so they are now present in all states of Malaysia, and they are looking forward to more opportunities in the East Coast and East Malaysia regions. And lastly, as one of the major distributors of Nestle, 99 Speed Mart should see volume growth as a result of normalizing sentiments on Nestle brands. Let me stop here and pass on to the next speaker. Thank you.
Okay, we move on to CelcomDigi's results. This is the third quarter, 9 months numbers, 400.3 million in terms of core earnings for the third quarter. Basically 9 months numbers, 1.21 billion in terms of core earnings. Within our expectations, 74% of forecasts, but below consensus numbers at 70%. I just want to highlight there were a couple one-off staff workforce rationalization, about 6 million. Bad debt provision of about 44 million. There was a misstatement that they corrected, as well as a handset debate. There was a double booking in the previous quarter, which they had to rectify in the quarter as well. So that amounted about 20 million. So all in, if you look at the three key one-off items, adjustments were about 42 million in the quarter itself. In terms of dividends, 3.6 cents, interim, third quarter interim. On a 9 months basis, the whole number is 11.1 cents now, slightly higher than 10.6 in the previous year. DPR of 108%, so they've been consistently paying, at the top end, or rather, whatever that's been made in terms of our earnings will be distributed to shareholders. No change there in terms of guidance for the full year. It's still low to mid single digit growth in terms of EBIT, low single digit service revenue growth. Very quickly, in terms of some of the key metrics, the prepaid numbers were fairly steady. They've been doing a bit of cleanup in terms of the prepaid base, focusing on higher value customers. So ARPU has actually gone up a fair bit into the quarter, offsetting some decline in terms of subs. But overall, prepaid revenues have actually held steady for the last 2 quarters. Postpaid numbers continue to be fairly strong. That's really coming from the upselling of the converged plan, which is the bundled fiber as well as mobile plan called CD1. That's basically that low-hanging fruit that's driving a lot of uptake into postpaid, new postpaid plans as well as family plans. Home fiber growth still fairly strong, double-digit growth, more than 30% growth on a year-to-year basis. So that's also driving a bit of that conversion into postpaid as well. The enterprise side, I think, there's been a bit of a lumpy impact here. That's coming from the structural pressure in terms of the SMS revenues. This is an industry-wide issue that's that all the other MNOs have also experienced. But management did say that we're probably seeing the tail end of this in terms of impact. Just very quickly, in terms of the network integration, as you know, they started integration way back in 2022. It's already the 3rd year of the integration. Full completion is expected by end of this year. They've so far modernized more than 90% of combined sites. So combined sites are basically collapsing both Celcom and Digi sites to consolidate one single site, and they've done about 70,000 sites altogether. So in terms of synergies, gross OPEX synergies also trending in line, 119 million for 9 months number. Integration costs at about 154 million. I think the concern here is that integration costs will continue to be elevated into 2026 because of a very slow and progressive upgrade of the IT network. IT upgrades are basically quite convoluted for a telco. It's a massive upgrade. For CelcomDigi, I think there are more than 100 subsystems to be upgraded. And they have just started phase 2 of this upgrade. So I think it will feature quite heavily in terms of integration costs for 2026. For phase 1, which started late last year, early part of this year, they've completed a third of it. So I think there's a little bit more to go. Management did say that potentially this cost may also spill over to FY27. Now, in terms of 5G, the wholesale cost has been quite steady in terms of quarter-on-quarter numbers, but relative to FY24, it's actually gone up quite a fair bit. This is because DNB has gotten its act together. They now have a lot more capacity to resell on their network. So they're charging the full extent of whatever that was agreed under the previous access agreement entered into 2022. Now, that access agreement is a take-and-pay clause. The MNOs have to pay 288 million per annum. But if you look at our PT disclosures within Celcom and Digi, so far they've actually paid about 173 million. This is a 9 months number. If you average that per quarter, they're paying about 50-odd million. So pretty consistent with what management has guided. Obviously they don't actually disclose outright how much that wholesale charges are to DNB. So we've not made any changes to our forecast. We've only a couple of weeks ago downgraded the stock to neutral. Concern really is on that that IT upgrades, which seems to be a lot slower than what we had expected. So the synergies are not coming through as fast as we want. A lot of these synergies will be backloaded into later part of FY26 and 27. So we're keeping a neutral call. Target price in terms of DCF at 395, that's about 9% upside. In terms of dividend yields, it's been fairly steady. Nothing really much to shout about. It's at about 4.4% for FY26. So for exposure, in terms of the mobile space, our preferred picks are basically Axiata and Maxis at this point. Okay, I will stop here for now, and we'll see you again. That's all for Morning Kappa this morning. See you.